Good afternoon, everyone, and welcome to another one of Avant Garde Trading's free educational trading webinars. My name is Natalie, and I'll be your moderator this afternoon. Thank you so much for joining us. We are thrilled to welcome you all here today, and more thrilled to welcome our guest presenter, Ken Keating. He is a principal at the OCC of Investor Education and an instructor at the Options Industry Council. And he is here with us this afternoon to speak to you all about using implied volatility to implement trading strategies. This is a wonderful topic and a great follow-up to the last webinar that Ken presented to our audience. So we are thrilled to have him here today. Ken, are you with us?
I am, Natalie. Let me go ahead and share my screen.
Wonderful. Thank you so much. And while you're doing that, just a reminder to everyone live in the Zoom room, if you have questions during Ken's presentation, go ahead and type those questions in the chat box, and I'll get them over to Ken to answer time permitting at the end.
Let me find the screen here. Sorry.
No worries.
Making sure that. Oh, sorry. Let me try one more thing.
No problem. While you're looking for that, Ken, another couple of housekeeping items for everyone present. Just a reminder, we are going to be recording this afternoon session. So if you have to leave early, or if you want to go back over something that Ken discusses today, you will be able to do so. You'll be receiving an email tomorrow. That's going to come from info@tradeagt.com. I've also put that in the chat to everyone if you want to copy and paste that email address into your own email address books. That email is going to have a link in it tomorrow, and that will take you right to the recorded replay. So you can watch the webinar back, download it as many times as you would like.
Okay, so let me go ahead and, for some reason, it was sharing easier before we were doing this, and I'm looking for the actual. Here, I'm just going to go ahead and share this, and you tell me if that's the.
Okay.
Do you see the cover?
There it is. Yep.
That's the
I
cover
do.
page.
I see
Okay.
the cover
You don't
page.
see,
Yeah.
I just don't want to be sharing like the one that's got all the multiple slides and the notes and everything. So
Right. No,
perfect.
I see the cover page.
Excellent. Okay.
And I'll shout in there if anything changes.
Perfect. Okay.
Okay.
All right. Well, thank you. And thank you everyone for joining us here today. It's always a pleasure speaking on behalf of Avant Garde and doing these webinars. I really enjoy doing these. So once again, my name is Ken Keating. I'm principal at OCC Investor Education, as well as an Options Industry Council instructor. And just to give you a quick background on myself, I've been at OCC for roughly 6 years now. Previously, before coming to OCC, I was a professional options trader for well over 25 years, both on floor and off floor. I traded on the Pacific Coast Options Exchange. I traded on the Chicago Board of Options Exchange as a floor market maker, as well as a floor specialist. I went back to San Francisco in the late 90s to run risk management for one of the largest privately held market making firms at the time. I worked for that firm for 15 years, both as a market maker, specialist, risk manager, off-floor prop trader. I then left that firm, ended up working for a capital management company where I worked. I traded a very large book of options off-floor. I also worked for myself for many, many years as a sole proprietor, as well as a derivatives and equities analyst. So currently, right now, I'm working at OCC, where I help individual investors such as yourselves to better understand both the risks and the benefits of exchange traded options. So speaking of the risks and benefits of exchange traded options, we always have to mention our disclaimer to keep all the lawyers at OCC happy. So anyone who's considering trading options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, one more slide to make all the lawyers happy at OCC. These are all the trademarks and logos that you'll see throughout the presentation, which are owned outright by OCC. Okay, a little bit about OCC and OIC. Who is OCC? Well, OCC is the Options Clearing Corporation and is the world's largest equity derivatives clearinghouse for exchange listed options. So OCC has been clearing and settling options since options started trading in 1973 on the Chicago Board of Options Exchange. So OIC is effectively who I work for, is effectively the education arm of OCC, who is our parent company. So OIC, the Options Industry Council, started out as a cooperative in 1992 to better educate the public on the risks and the benefits of exchange traded options. And we do that primarily through our website, optionseducation.org. There you'll find free online courses, podcasts, videos, as well as additional webinars, just like the one you're listening to right now. So this is a free service, and we can offer you this service free of charge because we are fully funded by the Options Clearing Corporation. So we have no hidden agenda. We just want you to be better educated, hopefully trading the product, understanding the product and trading it to meet all your investment objectives and having success with it. So if you ever have questions regarding the product, you can always reach out to us at options@theocc.com, Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options related questions. This too is also a free service. So just know that we are not registered advisors. So we cannot direct you on trades. We cannot critique your trades. We can't tell you where you should be investing your money in the options market, but we can talk to you about general theory, general strategy, also how corporate action may impact your options position. If you trade long enough, at some point, you're going to be presented with some type of corporate action, whether that's a merger, a forward split, a reverse split, maybe a rights offering, maybe a special dividend. And these all affect and impact options contracts differently. So if you ever have questions, shoot us an email, and we're always more than happy to help you out. We have 4 people on our team, including myself, and collectively we have well over 100 years of trading and brokerage experience. Okay, here is one of my favorite charts. This is an annual options volume over the last 25 plus years. And as you can see, the growth and trajectory of the volume numbers have just been phenomenal. So last year was the 5th record year in a row for the industry. Last year alone, we cleared and settled 12.2 billion contracts. Okay, we are averaging roughly 48.5 million contracts on a daily basis. So when I left the floor back here, back in the end of 1999, roughly 2000, we were clearing and settling roughly 2 million contracts on a daily basis, which at the time felt like a lot of volume, and at the time it certainly was. But as you can see, volume numbers have just continued to run higher. So right now for 2025, we're already averaging 55 million contracts on a daily basis. So, if we stay on this trajectory, we're probably going to have another record year, possibly clearing and settling northwards of 13 billion contracts. So certainly no lack of investors using the product, both to hedge and speculate and achieve their investment objectives. But this also, from our viewpoint, also highlights the need for continuing education, because while options, they're not overly complicated once you start understanding them, but they do take some education, and hopefully this webinar will enlighten you a little bit more about about volatility and its impact on you as a trader. All right, so let's get into it. So today we're going to be talking specifically about using implied volatility to implement trading strategies. Okay, so we're first going to talk about historical volatility. What exactly is historical volatility? Then I'm going to get into implied volatility, the nuts and bolts of the presentation. Then we'll talk about Vega. Vega is your options Greek that tells you how sensitive your options position is to changes in implied volatility. And then we'll be looking at historical implied volatility after that. And then lastly, I'll talk about some strategies that you may incorporate where you can apply that are pure vol strategies that you might use based on your forecast of a particular security harnessing implied volatility. Okay, so it's really important to understand. I always tell people this, that having an understanding of implied volatility is really crucial when you're trading options. And implied volatility is one of the most misunderstood but crucial aspects of trading options. So if you want to trade options successfully and profitably, which I know you all do, you need to have an idea of implied volatility, how it can impact you, but not only that, how you can harness it and use it to your advantage at given points in time. Okay, so hopefully this webinar will do that for you. So let's get started. So volatility, what exactly is volatility? Well, simply put, volatility reflects fluctuations in an underlying stock price, okay? This can be moves to the upside, it can be moves to the downside, and it's given over a period of time. So let's just say we're looking at a chart here, and this chart has two stocks. Let's just say stock A here in black is stock A, and stock B is this stock in orange. And as you can see, both stocks start and end at the same point in time. Okay, they both start and end at the same price point. But as you can see, stock A, which is a lot more volatile, takes the more scenic route to get there. Okay, so this we would obviously say that stock A is more volatile than stock B. All stocks have a certain amount of volatility. Okay, obviously utility stocks are going to be less volatile than say social media stocks, or bank stocks are going to be less volatile than software stocks. Okay, so it doesn't imply a price trend. Okay, it's more of a backward looking metric that's telling you how volatile a security has been in the past. Okay, so let's look at historical volatility again. So once again, when I talk about historical volatility, what I want you to think about is historical volatility is a backward-looking metric, and it's telling you how volatile, once again, stock has been in the past. Okay, so it's a rear view looking metric, and it's not a prediction, it has no predictive value whatsoever. It's just showing you how volatile a stock has been. So you can think of it like an electrocardiogram or an EKG for your stock price. So just like an EKG measures your heart rate, okay, when you get really excited, your heart rate goes all over the place, right? So this is kind of like measuring how volatile that stock has been over a given period of time. And we can use this to help us get a feel for how the options might be priced in a particular security. But just keeping on this one track on historical volatility, let's look at three different stocks: stock A, stock B, and stock C. And each one of these stocks are $100 stocks. And stock A here in gray trades at a 15% historical volatility. In other words, it's the least volatile of the three. And it has the tightest price distribution around its mean price. Then you have stock B here that trades at a 25% historical volatility. It's a little more volatile. And then stock C in yellow is the most volatile. So stock C has the most amount of price distributions around its $100 mean price. So if I were to ask you, which stock do you think would have the more expensive options, stock A, B, or C? Well, naturally, if stock C is more volatile, historically, you might assume that the options on stock C are more expensive than the options on stock A or B. And more often than not, that would be the case. But what if I said stock A is reporting earnings tomorrow and stock C reported earnings yesterday? Well, it could very well be that the options on stock A are more expensive than the options on stock C. So what do these price distributions or these historical volatilities tell us about the future volatility of the stock? It tells us nothing, right? This is, once again, this is a backward-looking metric. So just because a stock has been volatile in the past does not mean it's going to continue to be volatile in the future. And just because a stock has been quiet in the past doesn't mean it couldn't move in the future. Okay, so once again, this is a backward-looking metric, and it's just measuring how volatile a stock has been in the past. Now, implied volatility, on the other hand, is a forward-looking metric. Okay, now only options have implied volatility, and it's one of the inputs that you put in to an options pricing model. So if I have an options calculator, and there's 6 components that go into an options calculator. It's the strike price, the stock price, the time to expiration, interest rates, dividends, if any, and there has to be an implied volatility assumption. And when you put all that into a calculator, it's going to spit out what is known as a theoretical value or a price for that option. So you can use an options pricing model, and we actually have one on our website that you can have access to for free. All you have to do is sign up for a free account, and we have a free a calculator as well as an implied volatility tool that you can use. But once again, every option has its own implied volatility. So essentially, it reflects the market's trying to anticipate how volatile that stock is going to be between now and its expiration, and it's doing so through the price of the options, and it's based on the consensus of all market participants at that time. So you can anytime you pull up your favorite stock on a options chain, think of the prices that you're seeing at any given time of the crowdsourced pricing for the options at that point in time. So you ask yourself, well, who's making all these prices? I see bids, I see offers, I see different strikes, I see different months. Well, the prices that you see at any given time are not random. Okay. So anybody who's participating in that market is having an effect on those options prices. Okay. There's buyers, there's sellers. There could be market makers like I used to be, standing on a floor making a two-sided market in options for a particular stock. It could be retail investors such as yourselves. It could be hedge funds, pension funds, banks. Anybody who's buying and selling options is having an impact on those prices. And because they're having an impact on the prices, they're having an impact on the implied volatility. So one way to think about implied volatility, one way I like to think about it is when you hear somebody talk about implied volatility, when traders talk about implied volatility, all they're really talking about is the level of options prices. So now you see these shows on CNBC and CNN, you have shows that are dedicated just to options. And you hear traders talking about vol, and vol is bid or vol is offered. All they're really talking about is the level of options prices. And options prices are determined by the supply and the demand for options at any given time. So just like you go in the supermarket and you see the price of eggs is through the roof right now because there's a very low supply because of the bird flu. Well, the price of eggs is through the roof. So once again, in this case, you've got a lot of demand chasing a lower supply. Well, it's no different than the options market. When you have more buyers than sellers, that pushes option prices higher. And because option prices are going higher, the implied volatility for those options is naturally going higher as well. And same thing on the sell side. If there's more sellers than buyers, a bigger supply of sellers, well, that's naturally going to push prices down, and that's going to result in lower options prices. And it's no different than in the options market. Okay, so let's look at the components of an options price. So if an option is in the money, okay, it's going to have two components. It's going to have both intrinsic and extrinsic value, okay? And if an option is at the money or out of the money, it's going to have no intrinsic value and 100% extrinsic value. So let's look at an example. So let's look at a 50 call, and the stock is trading 55. Okay, well, with the stock trading 55, a $50 call is going to have $5 of intrinsic value. It's the right to buy stock at 55 or at 50, even though it's trading for 55. So this option, at a minimum, has to be trading for $5 because it's $5 in the money. So it's the stock price less the strike price. Well, maybe this option has 3 weeks to go, and it's not trading for 5, it's trading for $6. So if it's trading for $6, we know that $5 of that options value is intrinsic value. Well, the remaining dollar has to be extrinsic value. And extrinsic value is comprised of time, interest rates, dividends, and implied volatility. So let's just say, for example purposes, this option is trading for $6. And some huge institution comes into the market and they want to buy 5,000 of these contracts. Well, they're not all going to trade at $6. Some are going to trade at 6, some are going to trade at 6.10, 6.20. Let's just say this big order gets cleaned up at $7. And for example purposes, let's just say the stock is in the exact same spot. Well, what's changed? Well, now the stock's still trading 55, but the option before it was trading 6, now it's trading 7. Okay. Well, this option still has $5 of intrinsic value. That has not changed. But what has changed is the extrinsic value. Okay. So previously, when the option was trading for 6, it had $1 of extrinsic value. Now it's trading for 7. It has $2 of extrinsic value. So when implied volatility goes up and down, it's impacting the extrinsic value portion of your option, not the intrinsic value. And it's this extrinsic value that is also subject to time decay, because as many of you know, as you get closer and closer to expiration, an option has a finite life. So it loses a little value every day through, you measure that through looking at your Greeks, and the Greek theta is how you measure time decay. But extrinsic value is what decays, not the intrinsic value. And once again, if we're looking at an at-the-money call or put, if stock's trading for 55 and we're looking at the 55 call and put, well, that option has no intrinsic value. 100% of its value is made up of extrinsic value and is subject to implied volatility changes, time decay, and whatnot, as well as out-of-the-money options as well. Okay, so kind of as a recap, historical volatility is a backward-looking metric and is measuring how volatile stock has been in the past. Implied volatility is a forward-looking metric and is only options have implied volatility. And once again, the market is trying to anticipate how volatile that stock will be between now and its expiration, and it is doing so through the price of the options. Okay, so will an option's implied volatility return to the stock's historical volatility? Well, it may or it may not. Okay, so why do you need to be concerned about implied volatility? Okay, so the changes in implied volatility directly affect the market value of your options. Okay, so it's constantly changing, once again, based on the supply and demand for options. So let's just say you put on a position today, and all of a sudden you log into your brokerage account, and tomorrow you look at your position, stock's in the exact same spot. Nothing's changed other than a day has passed in time. And all of a sudden you look down at your P&L and you're either up or down a bunch of money, and you're scratching your head saying, I don't understand, like, what's going on? If you can't figure out why you're making or losing money on a particular options position, more often than not, it comes down to changes in implied volatility. So how does implied volatility affect options prices? Okay, so as implied volatility goes up, it's going to affect both call and put prices naturally. Okay, so because there's a concept known as put call parity. So calls and puts that share the same strike in the same month have a direct relationship to one another. So going back to that example where I was talking about the call, where the $50 call went from $6 up to 7, and the extrinsic value portion of the option went from $1 to 2. Well, because the call went up by $1 in extrinsic value, that 50 put has to go up by $1 as well. Okay, or else there would be an arbitrage there where you could buy the cheaper option, sell the more expensive one, hedge it with stock, and lock in a risk-free profit. So just know that calls and puts that share the same strike in the same month have a direct relationship to one another. So as implied volatility increases, both call and put prices naturally increase. And on the downside, as implied volatility or prices goes lower, both call and put prices will naturally decrease. Okay, so another thing, I know I talked about two types of volatility. I talked about historical volatility and implied volatility. There's also something called historical implied volatility. This is where you are looking at the implied volatility, in other words, the options price, but seeing where it's been in the past. And this is where, by looking at the historical implied volatility of the options, you can get a feel for where the volatility is. In other words, where the options have been priced, and it allows you to get a feel to compare based on where the options are trading right now, based on where it's been historically. So we'll get into this in a bit. But once again, you can't really dictate the level of implied volatility that you're buying or selling. You can only take what the market is giving you at any given time, okay? So what you really want to do is determine where implied volatility is now compared to where it's been historically and determine, well, right now it's historically cheap or it's historically expensive. Once you know that, now you can come up with the appropriate strategy to use, whether you're bullish, bearish, or neutral, because not all strategies work under all circumstances. Some work better in low vol environments, some work better in high vol environments. We get calls from people all the time that they don't really understand implied volatility, and they go ahead and they buy a bunch of calls because they're bullish on a stock, not realizing that they're paying a high price for those options. The implied volatility is really high, and they wonder why when the stock rallies, they're not making money. Okay, well, it's because they overpaid for the options. So this is how you analyze implied volatility. So these are two charts. We have an implied volatility, a historical, a free 1 year historical and implied volatility tool on our website. And once again, you can go to our website, sign up for an account for free, and you'll have access to this. But this is what I used to do all day as a market maker when I'm standing in a pit and I'm trading, my 200 stocks or whatever it is, and I'd be looking at volatility charts all day. Okay, so what we have here is have stock A on the left here and stock B on the right. The orange line that you're looking at is the stock's historical volatility, and this is over a 1 year period. The green line superimposed on this is the implied volatility, the options. Okay, so let's just look at this chart over here on the left. Stock A. It has a 52-week implied volatility range of roughly around 15 up to like 25. Okay, so when I was a market maker, this is what I do. I'd say, okay, well, my buy sell range is when options get into the mid to low teens, I'm more of a buyer. And when it gets into the mid to high 20s, I'm more of a seller. Okay. So, when you can see that when the implied volatility gets low, it kind of historically drifts higher. And then when it gets high over time, it historically drifts lower. That's what's called mean reversion. Volatility is a mean reverting concept, but it only reverts over a long period of time. Okay. But, this is why when you look at these charts, now you can get a feel for where the implied volatility is. So if I'm looking at this chart, and the range is 15 to 25. Well, right now it looks like the implied volatility is roughly, call it, I don't know, 17. Okay, so where is that? Okay, that's kind of still on the low side, in terms of options pricing. So maybe I might gravitate to option strategies more as a buyer rather than a seller. Okay. Look at stock B here. Okay, stock B trades at a higher volatility. Its 52-week range is 33 on the low side, 90 to the high side. Okay, so it has, obviously a lot more volatility. Now, I can't tell you which stocks these are, but I can tell you that stock A on the left here was a utility stock, and stock B on the right was a software stock. Okay, so you can see that the low point for stock B is, near the high point of stock A. So every stock has, once again, its own historical volatility. And if it trades options on it, you can look at an options historical implied volatility chart to get a feel for where the options are priced. Once again, if I'm trading this kind of volatile stock over here, and I know that the weekly range is 33 up to 90, and right now, at this point in time when we took the snapshot, it looked like the options were trading in the low 40s. Well, that's on the cheaper end. I probably don't want to sell options, selling option strategies when volatility is this low. I'm probably maybe going to gravitate more to options, from the buy side or putting on debit spreads, things like that. When options are really expensive up here, obviously I'd want to be more of a seller than a buyer, but selling options can be rather, they can get very risky. Okay, but there are strategies, and I'll talk about them later, where you can actually sell high implied volatility and mitigate your risk, things like credit spreads. butterflies, condors, iron butterflies, things like that. So there are ways you can harness and sell implied volatility while taking less risk. Because anytime we sell options outright, obviously there's a lot of risk right there, right? But there are things that you can do, whether you're bullish, bearish, or neutral, when implied volatility is high. And there are strategies that you can incorporate that allows you, once again, to sell high implied volatility while mitigating your risk. Okay, so there's a couple volatility analytics that some brokers offer that are out there. One is called IV rank and another is IV percentile. Simply put, these are just analytics that allow you to measure implied volatility. So what they're really going to do is it's kind of like looking at an implied volatility chart like I just showed you here, but it's going to do the legwork for you. So IV rank, what IV rank is doing, it's comparing the current level of implied volatility to its range over a defined period of time. So if I look at a chart and I see that the low point of the year or 2-year period, or whatever period I'm looking at is 20%, and the high point is 60, and the current implied volatility is 40, well, that's right in the middle of this range, right? So that would yield an IV rank of 50%. In other words, options are neither really cheap nor are they really expensive. They're kind of in this no man's land of right in the middle of its 52, or no, whatever time period of its range here. It's at the 50th percentile. If the time frame chosen in this case is 1 year and the IV rank is 0%, that means that the current level of volatility that we're looking at is the cheapest it's been all year. And an IV rank of 100% would mean that the current level is the highest of the year. Now, IV percentile takes that analysis and it takes it on a more granular, and it analyzes it on a more granular level. So IV percentile takes the percentage of days that implied volatility has been lower than the current level. Okay, so if this analytic is telling me that IV percentile is 60%, what that's saying is previous levels of implied volatility over this time period have been below the current level 60% of the time. So basically, it's just another way of telling you that the option prices currently are on the pricier side. Okay, so what does all this mean? Like, what is a 30 vol mean? What does that mean? Well, I'm going to tell you. So when people are talking about vol, okay, vol is a function. Volatility is a function of the square root of time and not time itself. So if we're looking at this fictitious stock OICX and it's trading at $80, and we see that the at-the-money options are trading at a 30% implied volatility. What that infers is that over the next year, this stock is expected to trade up or down about 30%. So 30% of 80 is 24. So we would call this the one standard deviation move. So we're going to do a little review of statistics here. So if this stock is expected to trade up or down 24%, or I'm sorry, 30%, which equates to $24, that means it's going to trade anywhere from between 56 and 104, 68% of the time. Okay, so we get that by taking 80, we add 24, that's how we get to 104. We take 80, we subtract 124, we get to 56. So based on 30 vol, what this means is 68% of the time, the stock is expected to trade between 56 and 104. Well, it has a 68% chance of trading within that range over the next year, then naturally it has a 32% chance of trading outside that range, either above 104 or below 56, because these probabilities have to add up to 100. Because a year from now, stock's going to be somewhere, right? It's either going to be below 56 or above 104 or somewhere in between. Now, if we want to know what the 2 standard deviation move, or the 2 sigma move, as some traders call it, you simply double this $24 number. So if you double 24, that gets you to 48. So the 2 standard deviation move, we do the same exercise. We take 80, we add 48, that gets us to 128. we take 80, we subtract 48, that gets us to 32. So based on a 30% vol, the 2 standard deviation move means that 95% of the time, the stock is expected to trade between 32 and 128 over the next year. And naturally, if it has a 95% chance of trading within this range, it has a 5% chance of trading either above 128 or below 32. And we could do the same thing for a 3 standard deviation move, just multiply 24 by 3. That gives us a range now of between $8 and 152. A 3 standard deviation move equates to a 99% probability that the stock will be between $8 and 152 over the next year, and naturally would have a 1% chance of trading outside that range. And you ask yourself, okay, well, that's all fine and good, but I'm not trading an option that, I'm trading an option that expires in 30 days. So does that mean that my stock's going to move 30% in the next, in the next month? Well, no. So once again, remember what I told you. I said that volatility is a function of the square root of time and not time itself. So this is called the rule of 16. So this is how you take that annualized volatility number and calculate a standard deviation for periods of less than 1 year. So this is the formula, and you can download the PDF for this presentation. You don't have to write this down, but this is a really neat little formula, and it's called the rule of 16. And you basically take the annualized volatility as a percentage, divide it by the time period squared, and multiply it by the stock price. Now, I know that sounds a little daunting, but just stay with me. So if we know the current stock price is 80, and we know that the options are trading at a 30% implied volatility, okay? Well, what's the 1-day expected move? Well, there's roughly 252 trading days in a year, right? Because stocks don't trade on the weekends. So if you take the 30 vol as a percentage, 0.30, divide it by the square root of 252. Well, the square root of 252 is roughly 16. That's why this is called the rule of 16. When you do the math, you multiply that by 80, you get plus or minus 150. So what that means is at a 30% implied volatility, this stock is expected to trade on any given day either up, within 1 standard deviation, between 81.5 and 78.5, 68% of the time. Okay, that's what that means. So that's how you take that annualized number and break it down into a more usable figure on a daily basis. Now, you can do this with any product that trades options, whether it is equities, whether it is ETFs. Okay, any product that trades options, you can use this tool or this formula to calculate lesser expected moves. We did this exercise for the 1 day, but let's just say we want to look at other time periods. Okay, so here is the other formula. So if you want to know we just did that experiment for the 1-day expected move divided by the square root of 252. Just so you know, the square root of 252 is not really 16. It's like 1587, but for all intents and purposes, it's close enough to 16. That's why they call it the rule of 16. If you want to do the same exercise and know what the expected weekly move is, you divide annualized volatility as a percentage by the square root of 52. That's going to give you the expected move over a week. You could do the same thing for a monthly period because there's 12 months in a year. You divide by the square root of 12. And if you want to know what the expected move over a quarter is, you divide by the square root of 4. That there's 4 quarters in a year. And once again, this is a really neat little formula. Most people kind of just use it to gauge what the 1 day or the 1 week expected move is, but it kind of gives you a little more better feel for what does this volatility number really mean? So once again, you have to break that annualized number down into a more, a lesser time period, and you do it by using this formula. So I hope that made sense. I know that's a lot, but that's a great formula, and it's great to have it on a little post-it or something on your screen that'll help you to kind of like break down the prices and the volatilities that you're seeing into more understandable figures.
Hey,
So
Ken.
yeah. Mhm.
Sorry to interrupt. I know we normally wait till the end, but I
Yeah,
know that
that's
was,
fine.
as you mentioned, kind of a heavy formula, and we had a couple of questions on it before you
Yeah.
moved on.
No, no, you want me
Just
to go back? You want me to go back to the,
yeah, just real briefly. That's great.
yeah.
One of the questions was for the rule of 16 on a 30% implied volatility. Did you say it was the outcome would be 60% of the time or 70% of the time?
So, okay, so when you do this, okay, this is calculating the 1 day expected move, okay? So the 1 day this $1.50 here, okay, when you divide by the square root of 252 into 0.30 as a volatility and multiply by the stock price, that's giving you the one standard deviation move. Because remember, a one standard deviation move happens 68% of the time. And
Okay, yeah,
a two standard deviation,
68%.
you're
Okay.
right. A two standard deviation equates to a 95% probability, and a standard deviation move equates to a 99% probability. So you could do the same exercise and say, okay, well, at a 30% vol, the two standard deviation move in this case is $3, right? Two times $1.50. So 95% of the time, I would expect that the stock should trade between $77 and 83, 95% of the time on a daily basis. So that's kind of like how you use, that. So this is the one standard deviation move, if that makes sense. So the 1 day expect
Yeah, thank you.
once, yeah. So I hope that answered the question.
Yeah, I think it should for Tim. Thanks, Tim. One other question was sort of along the same lines. You were mentioning rank or percentages. Is there one
Uh-huh.
that you prefer over the other? Do you mind just
Um,
asking?
yeah, so they're both good. So basically, Ivy rank kind of does what we were doing before on these chart, like basically breaking down the high and the low and telling you as a percentage where implied volatility is now, where Ivy percentile takes all the periods over like a yearly period, and it tells you what percentage of time the implied volatility has been lower. So this they're both good. Percentile is a little more granular because it's taking more price points, but they're both good. You can use them interchangeably. But this is basically the Ivy ranks just going to kind of, that exercise that when we were looking at that implied volatility chart, it's kind of doing the work for you and telling you where volatility is compared to where it's been. And then Ivy percentile is just simply a more granular viewpoint of implied volatility. So yeah.
Gotcha. Okay. Thanks so much for the clarity.
Mhm.
Sorry for the interruption.
No, no, it's fine. I mean, I want people to understand this. I know it's like when you start talking about
Yeah.
standard deviations and vol, it's like, it can get a little confusing, but like, you know, once you kind of wrap your head around this stuff, it's really, it'll sink in. Trust me, it will. So,
Sounds great.
let
Thanks,
me
Tim.
see. Sure. So Vega is your options sensitivity to changes in implied volatility. Okay. So this is your options position. When you have an options position, you're going to have a Greek position. And one way to think about the Greeks is the Greeks are like a dashboard to your options position. Okay. They're giving you feedback as the condition of your options position and how your options position might change depending on if the stock changes, if time changes, if implied volatility changes. So Vega is telling you how much your options position is going to change with each 1 percentage point change in implied volatility. It always is expressed in a decimal form. It represents a cash amount of per option, all other pricing factors remaining constant. Now, Vega is always going to be greatest for the longer term at the money options. And that's because those options have more extrinsic value or time premium, right? So an option, if stock's trading for 100 and I'm looking at the 100 level call that's exactly at the money that expires in a week, maybe it's trading for $4. But the same option, the $100 option that expires in a year from now might be trading for $25. Okay, so it has more time premium. Because it has more time premium, it is more susceptible to changes in implied volatility. So once again, calls and puts have both positive Vega amounts. So as implied volatility goes up, your option should increase by the amount of the Vega. As implied volatility goes down, your option will decrease by the amount of the Vega. And why this is important is because oftentimes implied volatility doesn't change in just 1 percentage point increments. Sometimes it changes in 5, 10, 20, 50% point increments. I'm sure many people remember the meme stocks that happened. It feels like an eternity, but it was like 2 or 3 years ago. And I remember watching, I can't name it, but there was one meme stock I was looking at. And before it got all crazy, the implied volatility for the options was trading right around 45 to 50. Over the next couple of months, the implied volatility went to 800. Okay, so I can tell you personally, when you're on the wrong side of an implied volatility move, it can be very, very painful. And just on the flip side, if you're on the right side of an implied volatility move, it can be very rewarding. Okay, so and once again, implied volatility can make huge moves based on how volatile a stock is anticipated to be. I'm sure many people remember the dot-com stocks when anything dot-com was just making parabolic moves both up and down on a daily basis. Well, the implied volatility for those options was through the roof. And I can tell you personally, it was very hard for people back then to even sell high, expensive options and make money on it because the underlying stocks were moving harder than the options were implying, and it was really hard to hedge. So it was a really weird period in time where the volatility went so parabolic that the only way to make money was to actually buy expensive options and not sell them. But once again, that's a whole nother webinar and another story. But over time, as volatility is mean reverting, you're going to be better served buying when it's low and selling when it's high because of that mean reversion. So let's look at an example here. So this is Vega in action. So let's just say we're looking at a stock. It's a $100 stock. It has 13 days to go to expiration, and the options are kind of expensive. They're trading at a 60 vol. It has interest rates of 4.3. So these are all the values with all the Greeks below them. So this 105 call is $5 out of the money, and currently it's trading for $2.76. Has a 36 delta, has a gamma of 3, theta of 16, a vega of 0.07, and a rho. This is your option sensitivity to changes in interest rates. So what this means, simply put, is if implied volatility went from 60 to 61, the option should gain about 7 cents. In other words, this option should be trading for about $2.83. If the implied volatility went from 60 down to 59, this option should be trading about $2.69. But let's just say we're bullish on this stock and we think they're going to report really good earnings numbers, and we decide to buy this option. Okay, so we buy this option, we pay $2.76. Well, let's fast forward a week from now. So a week from now, the earnings comes out. The stock goes from 100 up to 105. It goes up by 5%, goes up by $5. The implied volatility, however, goes from 60 down to 30. It gets crushed because once the news comes out, there's no reason for these options to trade at such a high price. This is called the vol crush, and the vol comes out of these options. Well, now you look at the option, you say, well, I paid $2.76 and now it's trading for $1.78. I don't understand. I bought these calls, the stock went up $5, and I'm still losing money. Well, even with a $5 increase in share price, these calls lost value due to you've got a week of time decay. Theta goes from, because remember, 7 days have passed between when you bought the option and when the earnings came out. Not only that, but the volatility went from 60 to 30%. So all things, when you factor that all in, these options are actually worth less money, even with the stock up. In this case. Now, had the stock made a 10% move, gone from 100 to 110, now would be a different story. Now, with the stock trading 110, the 105 calls would have $5 of intrinsic value, maybe a little bit of time premium, maybe a quarter. And now you pay 276. Now you'd be sitting on a profit. But in this case, you needed a bigger move than 5% to make money on these options. You probably needed like a 7.5 or 8% move. And we get calls from people all the time saying, I don't understand what happened. Well, this is what happened. You bought options that were very expensive and you needed a really big move to the upside to profit from this and from them. And in this case, a 5% move didn't cut it. And a 5% move in this case, actually, you end up losing 98 cents on this option in this case. So this is kind of like a real world look at how volatility impacts your options position. Okay, So really quick, now we're going to look at some pure, I can't go over all the strategies, but some of the pure vol strategies. This is called the long straddle. And the straddle is simply when you buy a call and a put at the same strike. In this case, let's just say we buy the 87 stocks trading at 87 and a half. We buy the 87 and a half call for 215. We buy the 87 and a half put for 185. So it's a net debit of $4 or 400 per straddle. And in this case, we don't have an opinion. We think the stock's going to make a big move, but we're not sure which direction. Okay. So in this case, a straddle might make sense. Okay. In this case, your break evens on this position at expiration is the $4 that you paid. And anytime you buy options, the most you can lose is the debit that you paid. So if we buy one straddle, this $4 straddle is going to actually cost us 400 because there's 100 multiplier for every standard options contract, because the price that you see in the options when you pull up your options montage is based on the per share cost for that option. But remember that every option is the right to buy or sell 100 shares. And this is why people love options, is because the leverage they afford you. So anytime you see a price in the options market, it's a standard contract, you have to multiply the price by 100 to get the true cost. So one straddle in this case would cost us 400. So we would need the stock by expiration to trade either above 91 and a half or below 83 and a half for us to make money. So right at expiration, and we get that by taking the debit that we paid, we add it to 87 and a half. That gets us to 81 and a, or 91 and a half on the upside. And we subtract it from 87 and a half to get to 83 and a half on the downside. So, if all of a sudden the stock finishes at expiration right here at 86, well, we're gonna lose money on this position. Anywhere between these break evens at expiration, we're gonna lose money. Now, if we bought the straddle for $4 and tomorrow all of a sudden we pull up on our screen and now it's trading for 450, well, what does that tell us? That tells us the implied volatility has actually gone higher. We could actually turn around and sell the straddle for 450 and take our 50-cent profit and not even and just and close the position. Okay, so you can certainly profit. You don't have to carry these positions all the way to expiration, but people typically put on long straddles when they think the stock is going to make a big move in either direction. They're just not sure which. So that's when you might use a straddle. And obviously this excludes transaction costs, commissions, and whatnot. Now the cousin to the long straddle is the long strangle. So this is where instead of buying the at the money option, we're going to buy the out of the money option. So maybe I don't want to pay $4 for the at the money straddle, but I still think the stock is going to make a huge move either up or down. Well, this is where a strangle might make sense. So maybe with the stock trading 87 and a half, I see that I can buy the 90 level call for $1.20 in this case, expires in 45 days. I can buy the out of the money 85 put for $1.30. So now my net debit is only $2.50. Okay, so it doesn't cost as much. It's 250 versus 400, but as you can see, my break evens are further apart. So I need an even bigger move, both to the upside and downside. So at expiration, we need the stock to be either at 92 and a half or above to at least break even or make money on this position. And on the downside, we need with the stock trading 82 and a half, and we get that by taking the 85 level put that we're long, subtracting the debit that we paid of 250, that gets us to 82 and a half. So as you can see, we need an even bigger move, both up and down, but we paid less for it. So, this is where somebody might use a long strangle. They think the stock's going to make a huge move. They don't want to pay as much, but they're willing to risk 250 in this case if the stock makes a big move either up or down. Now, I'm not advocating that you buy straddles or strangles. Some people sell straddles and strangles. So once again, straddles have a higher cost and lower leverage, and the break-even points are closer together. Okay, so remember that somebody who buys a straddle, well, somebody on the other end of that trade is selling the straddle. Okay, so if you buy a straddle, you know how much you're gonna possibly lose. It's whatever you paid for that straddle. The person who sells that straddle is going to be short the straddle. and they don't need movement. They're the most that they can make is whatever they sold that for. In this case, if I sold Natalie bought the straddle for me for $4 and I sold it to her for $4. Well, the most I can make is the $4 that I sold it for. And now I'm open to this huge risk to the upside. I have unlimited risk on the upside with my short call, and I have risk down to zero on my short put. Okay. Now, I'm not, some people are very risk, are willing to take more risk. And some people do sell straddles and strangles. Okay. But um, once again, strangles have a lower cost and a higher leverage, but the break-evens are further apart. And once again, the person who sells the strangle is also open up to, upside risk to the upside, unlimited upside risk to the upside through the short call, and risk down to zero through the short put. Now, there are strategies that I mentioned earlier where you can sell high implied volatility to mitigate your risk. Things such as credit spread. So maybe I'm bearish on a stock, implied volatility is high. Maybe I would sell it's called a bear call credit spread. So I sell a call at one strike and I buy a call at a higher strike against it. I'm going to take in a credit for that. And hopefully I want both options to expire worthless. I want the stock to go down. If it goes down, then I keep the full credit from the credit spread. If you're bullish, you could sell a bull put credit spread. In other words, you're going to sell a put at one strike. You're going to buy a lower strike put against it. You're going to take in a net credit to do that. If the stock rallies and at expiration, both options theoretically expire worthless, you end up keeping the full credit. Strategies such as butterflies, condors, iron butterflies, those are also strategies that you can use to take advantage of high implied volatility. In other words, selling high implied volatility while mitigating your risk, because the risk is defined on those. A risk is somewhat undefined in a short straddle or a short strangle. In a butterfly, a condor, an iron butterfly, an iron condor, a credit spread, you know where your risk is. Your risk is somewhat defined as long as it's within that spread itself. And so this is why some people will choose to trade those strategies to take advantage of high implied volatility, be able to sell high implied volatility while also not taking on as much risk. So, but once again, for buyers, people who buy options, time decay or theta is working against you. Okay, so you need movement. People who buy options need movement for, if you're long calls, you need movement to the upside. If you're long puts, you need movement to the downside. When you sell options, you don't want movement. Okay, you just want stocks to be quiet, range bound. Every day they lose a little bit of value every single day. And at expiration, they either expire worthless or less than what you sold them for, and you can buy them back. And whatever the difference is your profit. Okay, so theta is a foe to option buyers, and it's a friend to option sellers. Okay, so once again, there's no right or wrong answer. I'm not advocating for any particular type of strategy, but this once again, you can't, just to kind of reiterate what I said earlier, you can't dictate what levels of volatility. You can't dictate what levels you buy and sell. All you can do is take what the market is giving you at any given time. So if you pull up your screen and you've analyzed the volatility and you see that implied volatility is on the cheaper end, well, you might want to gravitate to strategies from the long side, whether you're bullish, bearish, or neutral. At the same time, if implied volatility is expensive, you might want to gravitate towards strategies where you're taking advantage of selling high implied volatility, such as credit spreads, butterflies, iron condors, things like that. If you're open to risk, and these are risky, you could sell straddle short, you could sell strangle short, but once again, they are risky strategies, and they're not right for everybody. But once again, I know that it was a lot of information, but for more information regarding this topic or any others, you can check out our website, optionseducation.org, to view our full online educational offering. Shoot us an email if you ever have questions regarding the product. If there's a question that comes up later on after you thought about this webinar or watched it again and you're still kind of confused about some of the topics, you can always shoot us an email. We're always more than happy to answer your questions. We do have an OIC YouTube channel where we archive many of our past webinars, as well as an on-demand webinar section on our website where every webinar that we do for OIC is archived and recorded. So if there's a subject you want to study more about, whether it's the Greeks, whether it's butterflies, iron butterflies, condors, credit spreads. We have done videos on multiple topics and multiple videos on multiple topics. And once again, it's a free resource. You can also access our YouTube channel where we also archive many of our past webinar presentations. So I know that was a lot, so I can bring back Natalie. I know we're right at an hour, but I'm happy to answer a few more questions if some more came in. And
Yeah, great. Thank you so much, Ken. I'm going to have you leave this slide up just for a moment, just to reiterate to everyone, write down this email address. If you have follow-up questions, visit the OIC YouTube channel. As a reminder, you're all going to get an email from info@TradeAGT tomorrow, and it's going to have a link to the recorded replay of this webinar. So you'll be able to watch this back as many times as you like. Yeah, like Ken said, we're right at an hour here. I don't see any additional questions right now. I think you addressed the ones that came in earlier. So thank you for that. And if anyone has follow-up questions specifically for Ken or his team, reach out to them at options@theocc.com. If you have questions for us over here at Avant Garde, you can reach us directly at info@tradeagt.com. Ken, thank you as always for taking the time to not only put together an incredible presentation, but to present it so well and to take the time to answer our attendees' questions. We really appreciate that. And I want to thank all the attendees who joined us live. And thank you to those who asked questions. It's always more enjoyable when we can go back and forth a bit. So appreciate everyone's responsiveness. And Ken will definitely be having you back soon. Everyone keep an eye out for future educational webinar invites in your inbox from Avant Garde. Thanks all. Have a good rest of your evening.
thanks, everyone. Thanks, Natalie.
Thank you, Ken. Have a good night.
You as well.